goods imported into the U.S. dropped for the second month in a row. Import prices fell 0.2% in June. That was better than what economists had expected. Year on year, they fell 6.1%. That is the biggest drop since 2020, and also the latest sign that inflation is easing, especially as the price of imported fuel is now down nearly 36% in just the past year. Consumers are already reacting. A survey by the University of Michigan out Friday found that consumer sentiment jumped to a 2-year high in early July. And on Wall Street, of course, they're talking about this inflation data and also big bank earnings. John Terrett takes us through the week that was.
Well, the week on Wall Street, of course, has been dominated by data. We had CPI with that headline figure of 3% on Wednesday, but the core coming in lower than expected, but still at 4.8%, and that's going to be a concern to the FOMC committee. Then on Thursday, we had PPI coming in pretty much flat. On Friday, we had the bank earnings, which were good, but there are some concerns. And of course, all this follows the weaker than expected jobs report for June from the previous Friday, which came in at 209,000, where 230 or 40 had been expected. So 209,000 is less than expected, but it's still quite elevated. And within that, remember, there were concerns about the average hourly earnings that the Fed will be worried about. So the scenario seen from this trading floor is that on July the 26th, when they make that decision, everybody here thinks it's a baked-in 25 basis point hike. Then they have a vacation in August, and then the theory goes that in September we'll either have another 25 basis point hike or there'll be a pause, and then whatever there is in September will be different in November, if you see what I mean. Either way, the sense here is that the Federal Reserve is coming close to the end of its interest rate hiking cycle, and the other sense from the floor here is that we haven't yet, these markets, peaked for the summer, so we'll see what happens. On the markets for the day and the week, well, Friday and indeed the whole week was quite a choppy sort of handful of days, really, one way and another, with those bank earnings and the inflation data peppering the news of the week. The NASDAQ and the S&P 500 on Friday snapped a 4-day winning streak. The banks failed to lift things with those earnings that came out on Friday, and the emphasis really was on growth over value. So here are the numbers then. The Dow was ahead by 1/3 of 1%, 113 points, with United Health leading the way. Best day for that since November 2020. The Dow to stand at 34,500 for the weekend. NASDAQ down 1/5 of 1%, 24 points, but Meta and Alpha were outperformers, not quite so much Apple. And the S&P 500, the broad market, was down 1/10 of 1% on Friday, 4 points. But for the week, it's up by 2.5%. John Terrett, CGTN, on the trading floor of the New York Stock Exchange.
For more on the economy and the markets, we're joined by William Lee, Chief Economist at the Milken Institute. Good to see you again. You seem to be pretty happy with these numbers. I think last time we spoke, we had a very vigorous debate on whether or not the Fed needed to raise at all at this point. Do you still feel the same way?
Well, actually, it's very good that the inflation is starting to come down. I think the Fed is still going to piss and moan about why the core is still so high and maybe a little bit more tightening is needed. But I think by September, as your reporter just said, it may well be that they'll say that enough is enough. And if the consumer really does slow down because the credit card has been so extended, maybe the Fed will just say, okay, we've got enough.
We had some interesting statistics in from both China and the U.S. Both are reporting that import prices are coming down. And I have to extrapolate that it must mean that demand, whether it's in the U.S. or in China or around the world, quite frankly, must be also easing as well, and that would put more deflationary pressure on the markets. Now, this is sort of the beginning of that process. It's going to take some time for this to work through the system. Why does the Fed, if that's true, why does the Fed need to even consider raising rates at this point?
Well, one of the things that causes prices to go down is that the supply chain has come back online. But one thing that could knock it out of kilter again is if the war in Ukraine starts to erupt again and the food supply and fuel situation starts to go berserk, and the Europeans and a lot of the emerging market countries are scared about energy safety and food safety. So the supply chain is better now, but it could go bad very easily. So the Fed has to be very cautious as to the balance between supply and demand, and you can't let demand get so high that it really overwhelms the amount of available supply in later on this year.
But it's not so high. I mean, again, I'll go back to the data. We see that the prices have come down, which indicates that demand is coming down, at least in terms of from the factory standpoint. And if you were to restrict the economy further or disrupt the supply chain even further by raising rates, that would only constrict supply, which would actually be the opposite of what the Fed wants, which would be to raise prices, wouldn't it?
Well, Phil, if I were grading that answer, I'd say B minus. Raising rates would actually lower demand more than supply, because supply is not so sensitive to the cost of interest rates, because right now, not many companies are really borrowing to finance expansion and to finance production. So what we have here is a situation where a lot of people still are spending, but the amount that they're spending is starting to ease off a bit because a lot of the people are starting to spend by going into debt. So what the Fed is going to do in September is to say, where is the balance? How's inflation going? Are the price of services coming down? I mean, when was the last time you got repaired your car, paid a tuition bill, or gone to the dentist? Those service prices are still in either double digits or high single digit inflation rates. So we have to sort of see a more widespread reduction in inflation before the Fed is satisfied that we're well on our way to 2%.
I had a vigorous debate earlier this week with another expert, and we were talking about how I don't see why any companies would reduce prices. Once you raise it, the propensity to reduce it is very hard. Case in point, rent. Once the landlord raises rent, they very rarely reduce rent because they're trying to maximize their own, revenue and profits. And I get that. But at the same time, as long as prices don't go up further, the expectation of them going down seems to be a bit much.
We're not expecting prices to go down. We're expecting the pace by which prices are raised to slow down. That's what, if we don't have any price increases at all, everything was steady as is today, there'll be zero inflation, the Fed will be jumping up and down. So we don't need prices to come down, we just need prices to stop going up as quickly. As I said, your garage mechanic is never going to lower the price of changing oil for you, but he may stop raising the prices every time you go to him.
The University of Michigan Consumer Sentiment Index is what I would consider a forward-looking indicator, right? Because if I ask you, how do you feel today, and you say, I feel good, I feel like I'm going to buy stuff, that means you're going to buy stuff in the future. And we just had the highest number in nearly 2 years on that. What's the disconnect from this inflation and things costing more and the economy maybe a little weaker, yet consumers are uncannily they seem very, very happy, and I'm perplexed by that. Why are they so happy?
Actually, Phil, I dug into those numbers a bit, and if you look at who's answering the questions, the rich consumers are saying, hey, I'm feeling pretty good. I've got enough to spend. I can actually go on my vacations. The poorer consumer is actually saying, things are not so easy. I'm having to do more credit cards. I'm going to have to cut back on what I'm spending on instead of the name brand. I'm buying the store brand stuff. So there's a wide divergence now between the rich consumer and the not so rich consumer. And I think that's where we're going to start to see some social tensions show up at the voting booth.
Well, and that's a few more months from now. I suppose in the meantime, if we can get this quote soft landing, that would make most people happy, albeit we also have a fantastic situation when it comes to unemployment. William, good to see you again. Have a good weekend.
You too.